Welcome, curious minds, to another deep dive where we cut through the noise to get to the heart of what truly matters.
It's great to be here.
Today, we're plunging into the fascinating, complex world of offshore oil and gas drilling. This is a sector absolutely vital to meeting global energy needs, right?
Absolutely crucial. And it's a really dynamic space right now. Lots of moving parts.
Definitely. We've got a treasure trove of information, and our mission today is to really extract the most important nuggets. We want to help you understand the strategic plays, the financial health of two major players in this space, Valaris and Noble.
Exactly. This deep dive is all about pulling apart their strategies, their financials. Where do they actually stand? How are they operating day to day? And crucially, what might their futures look like? It's a complex picture.
And we're going to tackle this by looking at, well, two very different ways they view long-term sustainability. That's a key theme today.
A major theme, yeah. Their perspectives are quite distinct.
We'll compare their operational strengths, their fleets, how well they run things. We'll look at the money side, financial performance.
Revenues, earnings, cash flow, debt, all that good stuff.
And dissect their contracting strategies. Who's winning, what work, where, and for how much.
Contracts are absolutely key in this business. The backlog tells you a lot.
Then we'll zoom out, look at the broader market outlook. Where's the demand? What are the big trends?
Get ready for some maybe surprising facts and maybe a few aha moments. Hopefully you'll come away really well informed about this critical industry.
Yeah, this isn't just about numbers on a page. It's like understanding this high-stakes chess match being played out in the world's oceans. It's pretty fascinating stuff.
It really is. So where should we start?
Let's dive right into Section 1, unpacking those analytical lenses. This difference in how Valaris and Noble look at the future is really striking. Let's start with Valaris and this unique 50-year view they've developed.
Right. It's genuinely fascinating because it's so different from how most companies, especially in cyclical industries, present themselves. Valaris has embraced, well, you could call it a radical valuation method. They're trying to look way, way beyond the usual quarterly reports.
Okay, 50 years. That's ambitious for any industry, let alone offshore drilling. How does it work? It sounds like they're flipping the script on valuation.
They really are. Instead of focusing on, say, the current book value of a drill ship or how it depreciates over time according to accounting rules.
Which is the standard approach.
Exactly. They're asking a much more fundamental question. What's the true long-term cost of just keeping this business running for half a century?
So treating the assets, the rigs, not just as things that make money, but as things that cost money over the very long haul.
Precisely. They call it the assets as liabilities method. The core idea is to treat all their physical assets, those massive drill ships, the jackups, not as, current value generators on the balance sheet, but as long-term financial obligations.
Like a mortgage you have to keep paying off, almost.
Kind of. Think about the initial purchase price, sure, but then all the ongoing maintenance, the upgrades, the inspections, the eventual inevitable replacement. This model tries to calculate the sheer amount of revenue needed over 50 years just for Valaris to break even, just to survive, not even grow.
Wow. So stripping away things like depreciation rules, currency fluctuations.
Yeah, they intentionally bypass a lot of that complex accounting noise. The goal is to get to the core underlying economics. What does it actually cost to sustain this fleet for 50 years? It's a simplified view, but it's designed to be foundational.
Okay, that's a truly foundational perspective, but a 50-year model has to make some pretty big assumptions, right? Especially about assets that cost hundreds of millions of dollars and operate in harsh environments. What are the core assumptions driving this?
They are quite specific, and they really underpin the whole thing. First, and this is a big one, they assume that rigs need to be bought twice and upgraded once over this 50-year span.
Bought twice, meaning a full replacement cycle.
It's exactly. This is based on the average useful lives of these assets. Jackups, they figure, last maybe 20, 30 years. Drill ships and semi-submersibles, maybe 25, 40 years. So for simplicity in the model, they just used an average rig life of 25 years.
Okay, so a rig you buy today gets replaced around year 25, and that new rig lasts until year 50.
That's the idea.
Yeah.
It represents this continuous cycle of massive capital expenditure just to maintain the current fleet size and capability. It highlights the capital intensity.
And these aren't cheap. What costs are they plugging in for these new builds? A 7th-gen drill ship today is?
Yeah, they apply specific estimated costs. A new drill ship is pegged at $600 million in this model. A new jackup, $200 million.
Mhm.
And remember, that's each time they need replacing over the 50 years.
Right, so for every drill ship they have now, that's $600 million today, hypothetically, plus another $600 million in 25 years, plus an upgrade somewhere in between, just to stand still.
That's the logic, yeah. It really starts to add up when you think about their whole fleet.
And what about the operational costs? Just running these things day to day, fuel, crew, maintenance. That's got to be huge, too.
Absolutely huge. The daily operational costs, or OPEX, are converted to annual figures in the model, and they are very significant. For drilled ships, they estimate $180 million per year when active.
$180 million a year per drill ship.
Per active drill ship, yeah. Think about what that covers. The highly skilled crew working in rotations, massive amounts of fuel, constant maintenance, spare parts, complex logistics to get supplies out there, the shore-based support, insurance, all the drilling consumables. It's immense.
It's for jackups. Less complex, but still.
Still considerable. They estimate $50 million per year for an active jackup. But here's a really important caveat they included in the analysis.
Oh.
There's a cautionary note that the actual drill ship operational costs could be much, much higher, potentially soaring up to $400 million, even $450 million per year.
Wait, 450 million? That's more than double the $180 million estimate.
Exactly. If that's the true cost, it completely changes the economics in the model. The break-even point gets massively higher. It makes the challenge look even more severe.
That's a massive variable, so the $180 million might be conservative.
It might be. Or it might represent a baseline, while the higher figures reflect peak conditions or specific complex projects. But the fact that range is mentioned suggests significant uncertainty or variability in OPEX.
Okay. And are there standard business costs like corporate overhead, debt interest, sales, and marketing? Are those included initially?
Initially, no. For that simplified, bare-bones operational cost view, things like corporate G&A, interest expense, marketing, they're excluded.
To get the pure rig level cost.
Right. But then these add-backs are incorporated later in the calculation to arrive at a more comprehensive, all-in break-even revenue figure.
So even with simplifying assumptions, it's designed to paint this stark picture of long-term capital needs.
Very stark. We'll definitely come back to the conclusions of this when we talk about sustainability later, but it's a radical way to frame just how capital-intensive this business truly is over the long, long term.
Okay, so that's Valaris's almost philosophical 50-year lens. Now, let's contrast that sharply with Noble. Their approach, as seen in their recent Q2 2025 earnings report, feels much more grounded, more focused on the here and now.
Absolutely. It's a night and day difference in perspective and communication style. Noble's reporting and strategic posture are very much grounded in immediate financial performance, strategic capital allocation decisions being made now, and a forward-looking market outlook, but within a more traditional time horizon.
Thinking quarters and maybe a few years out, not decades.
Exactly. They're not publicly wrestling with 50-year existential questions in the same way. They're focused on managing the business effectively today and positioning for the foreseeable future.
And what's the tone from their leadership? Does it reflect this difference?
Very much so. Noble's president and CEO, Robert W. Eifler, in their Q2 commentary, highlighted resilient earnings and free cash flow delivery against a backdrop of elevated macro volatility. That's the language of a company confidently navigating current challenges.
Right, resilient delivery, navigating volatility. It sounds like they feel they're managing the cycle effectively.
That's the strong impression.
Yeah.
It signals a focus on adaptability, strong execution, getting the job done despite market headwinds, rather than projecting, a deep, long-term financial conundrum like the Valaris model implies for the whole industry.
It sounds like a management team focused on what they can control right now. What's been a key factor in their recent performance that maybe backs up this confidence?
A crucial element they highlighted was the successful achievement of integration targets following their big acquisition of Diamond Offshore Drilling, Inc.
The diamond integration, that was a major move.
Huge. And hitting those synergy targets, cost savings, operational efficiencies, successfully merging the fleets and cultures, that's not easy. The fact they're reporting success there suggests strong execution internally. It's a big validator for management's capability.
So internal efficiencies are a big piece. How do they view the external market? Are they seeing the same pressures as Valaris or focusing on different aspects?
Noble emphasizes, and I quote, judicious management of costs and marketed capacity.
No.
So very focused on optimizing their current fleet, controlling expenses, being smart about which rigs they offer to the market and when.
Active management of supply.
Right. And alongside that internal focus, they point to encouraging indicators of increasing deepwater demand in the mid to longer term. So they see the cycle turning.
Okay, so while Valaris is fundamentally questioning the long-term economics, Noble is focused on optimizing within the current market structure and anticipating an upturn driven by that returning deepwater demand.
Precisely. It's a pragmatic, market-responsive approach. Manage costs tightly now, position the fleet well, and get ready to capitalize when demand strengthens, which they seem confident it will.
Two very different philosophies then. One looking 50 years out and sounding a warning bell for the whole industry structure, the other focusing on resilience, adaptation, integration success, and capitalizing on the next upswing.
It really shapes how they operate and communicate.
Okay, let's move into section 2. How do these different perspectives actually play out in the day-to-day? Specifically, when we look at their fleets, the actual rigs, and how well they operate them. Let's start with Valaris again. They really seem to emphasize their high-spec, high-efficiency rigs, right?
That's definitely a cornerstone of their strategy and messaging. Valaris boasts a highly specialized fleet, and they have a particular strength in drill ships. Those are the big self-propelled vessels for ultra-deep water.
And the key stat there is the 7th generation units.
Exactly. A standout fact they highlight is that 12 of their 13 drill ships are 7th-generation units. That gives them, as I say, the highest concentration in the industry.
12 out of 13. That's heavily weighted towards the newest tech.
It is. And this isn't just, a marketing number. It translates directly into a significant competitive edge, especially for the most complex and demanding deepwater projects.
Okay, so let's really unpack that. For listeners who aren't steeped in rig specs, what does 7th generation actually mean in practice? Why would an oil company pay, 25% more per day for one?
Yeah, the premium is real. Over the past year, 7th-gen drill ships have commanded about 25% higher day rates. And maybe just as importantly, nearly 10 percentage points better marketed utilization compared to 6th-gen units.
So they work more often and get paid more. Why? What's the magic?
It really comes down to superior technical specifications and critically redundancy. 7th-gen rigs typically offer features like dual derricks.
Two derricks.
Yeah, which allows for parallel operations. You can be drilling ahead with one while preparing the next section of casing or running equipment with the other. It shaves significant time off the well construction process. Time is money, big money, offshore.
Okay, so faster drilling through parallel operations. What else?
Higher hook load capacity. That means they can handle much heavier loads, longer strings of drill pipe and casing, larger, heavier blowout preventers, or BOPs, which are those critical safety devices. This allows for drilling deeper, more complex wells.
Bigger BOPs mean more safety margin too, presumably.
Generally, yes, and often they have two BOPs installed, a primary and a backup. That redundancy is huge for minimizing downtime and enhancing safety. If one BOP needs maintenance or has an issue, you can switch to the other without pulling the whole stack back to the surface, which takes days.
Okay. So less downtime, more safety.
Definitely. They also have higher capacity thrusters, which means they can hold their position more accurately and reliably, even in rough seas or strong currents, using dynamic positioning systems. Better station keeping is crucial for safety and operational continuity.
So all these features, dual derricks, high hook load, dual BOPs, better thrusters, they all add up to significant efficiency gains, especially on longer projects.
Exactly. Over a multi-well drilling campaign, these features amplify efficiencies. You save hours here, days there, and it really adds up. That's why operators undertaking complex, long-term deepwater developments are often willing to pay a premium for these 7th-gen capabilities. They are truly the elite tier of the deepwater drilling fleet.
Got it. So Valaris is heavily invested in that top tier. Now, beyond the deepwater drill ships, they also have a jackup fleet for shallower waters. How does that part of the business contribute?
Their jackup fleet is described as a strong contributor to their financial performance. They're expecting EBITDA growth from the jackups in 2025.
And why is that? Just better market conditions?
Primarily due to having more operating days, higher utilization, and achieving higher average day rates for those units. Jackups often serve more regional markets, sometimes harsher environments like the North Sea or specific niches. Valaris has positioned its jackup fleet strategically in several key areas, allowing them to benefit from that more localized demand.
So a balanced portfolio, but with a clear emphasis on the high-spec deepwater side. Now, what about just running the rigs well? Operational excellence, safety that has to be paramount.
Oh, absolutely critical. You can have the best rig in the world, but if you don't operate it safely and efficiently, it doesn't matter. Valaris strongly emphasizes their commitment here.
And the numbers back that up.
They reported a fleet-wide revenue efficiency of 96% in Q2 2025. That's an incredibly high number in this industry.
96% revenue efficiency. What does that mean exactly?
It means that for 96% of the time their rigs were technically available under contract, they were actually operating and generating revenue. The other 4% would be downtime due to things like unexpected maintenance, waiting on weather, or other operational pauses. Achieving 96% shows really effective asset utilization, minimized downtime, and efficient project execution across the whole fleet.
That's impressive. And safety. Any major incidents?
Their safety record is equally strong. They reported 0 lost time incidents LTIs in the first half of 2025. An LTI is an incident serious enough to cause an employee to miss work, so achieving 0 is the gold standard everyone aims for.
That's crucial for client trust, insurance, everything.
Absolutely, and they highlighted specific rigs with outstanding records. Valaris DS-10 achieved 2 years without any recordable incident, not just LTIs. Valaris 107, 118, and 248 each marked 1 year recordable free. This kind of consistent safety performance is fundamental. It builds trust with customers, helps secure those long-term contracts, manages their risk, and frankly, it's just the right way to operate.
It really speaks to their operational discipline. Now, you mentioned their strategy for managing the fleet, bookending the white space. Can you unpack that phrase a bit more? What does it look like in practice for their drill ships?
Yeah, it's a key part of their commercial strategy, aiming to maximize asset value and avoid costly idle periods. Bookending the white space means their primary goal is to secure attractive, long-term contracts first for their drill ships. Those anchor contracts provide stability and high-value work.
Okay, get the long-term base load secured.
Exactly. Then, once they have those bookends, they actively look for shorter gap-fill opportunities to slot in between those longer contracts, filling the white space on the rig schedule.
So they're not just chasing any short-term job that pops up.
No, the emphasis is on strategic placement. They want to avoid the very costly and operationally inefficient cycle of ramping up a rig's crew and systems for just a short, isolated job, only to have to stack it again afterwards. That mobilization and demobilization is expensive.
Right, you want continuous work if possible.
Precisely.
Mm-hmm.
So the focus is on maintaining low operating costs during any unavoidable idle periods and strategically filling gaps that connect longer contracts. It's about creating a smooth, continuous revenue stream rather than jerky stop-start operations.
A very disciplined approach to scheduling, and this discipline extends to getting rid of assets that don't fit the strategy too, right? Asset rationalization.
Absolutely. Prudent fleet management means knowing when to let go of assets as well. Valaris recently completed the sale of 3 benign environment semi-submersibles. These were older, less capable floating rigs.
Sold for recycling.
Sold for recycling, yes.
Oh, yeah.
They recognized the market for that specific asset class was challenging, likely with limited future prospects. So they decided to exit rather than keep paying maintenance costs on underutilized assets. It's about focusing capital and effort on the core high-spec fleet.
Makes sense. Any other sales?
They also announced the sale of the jackup Valaris 247 for about $108 million in cash. Again, likely an older or non-core unit. It's a clear pattern. Shed older, less strategic rigs, optimize the portfolio, generate some cash, and focus resources on the high-spec 7th-gen drill ships and their strategically placed jackups.
Okay, clear strategy from Valaris. High-spec focus, operational excellence, strategic scheduling, and shedding non-core assets. Now, let's compare that to Noble's fleet dynamics. They have a broader fleet, right? More diverse. Yes, Noble operates a larger and arguably more diverse marketed fleet. They list 25 floaters that includes drill ships and semi-submersibles of various generations and 13 jackups.
So less concentrated on just the absolute top-tier 7th-gen drill ships compared to Valaris.
Generally, yes. While they certainly have high-spec Tier 1 drill ships, their fleet includes a wider range of capabilities, including 6th-generation floaters and harsh environment jackups. This diversity allows them to bid on a broader spectrum of projects globally, not just the ultra-deepwater niche. How did their fleet utilization look in Q2 2025? Valaris was at 96% revenue efficiency, but that's slightly different from overall utilization.
Right. Revenue efficiency is about uptime while contracted. Fleet utilization is about how much of the marketed fleet is actually working. For Noble in Q2, their overall marketed fleet utilization stood at 70%.
70%. How does that compare to the previous quarter?
It was actually down from 78% in Q1, so a noticeable dip.
Any breakdown between floaters and jackup?
Yeah, floaters were at 75% utilization in Q2, down from 80% in Q1, and jackup saw a bigger drop, down to 61% utilization in Q2 from 74% in Q1.
Okay, so lower utilization overall in Q2 compared to Valaris' high revenue efficiency, though they measure slightly different things. What about Noble's day rates during that quarter?
For Q2 2025, the average day rate across their contracted floater fleet was $400,802. For their jackups, the average was $176,503.
Okay, those are the averages. What about new contracts signed, the leading edge rates?
That's where it gets interesting. For their Tier 1 drill ships, their highest spec deepwater rigs, leading edge day rates secured in Q2 were in the low to mid $400,000.
Low to mid 400s. That sounds pretty much in line with where Valaris was signing their 7th gen rigs recently.
Exactly. It confirms that range as the current market level for top-tier assets. For Noble's 6th-generation floaters, new fixtures range from the low $300,000 to the mid $400,000, reflecting the tiering in the market. And for harsh environment jackups in the North Sea, they reported somewhat stable leading-edge day rates.
So even though overall utilization dipped a bit in Q2, the pricing for new contracts on their best assets held up well.
That seems to be the case. It suggests the dip in utilization might be due to timing of contracts ending or specific rigs undergoing maintenance rather than a collapse in pricing power for desirable assets.
And Noble is also actively managing its fleet through disposals, similar to Valaris, getting rid of non-core or idle rigs.
Yes, very actively, particularly focusing on shedding non-earning cold-stacked assets. They completed the disposal of 2 cold-stacked drill ships, the Pacific Sirocco and Pacific Meltem, for a combined $41 million.
Cold stacked means they're basically mothballed, right? Not expected to work anytime soon.
Exactly. They're parked, systems preserved to some extent, minimal crew, just incurring storage and maintenance costs without generating revenue. Selling them, even for a relatively low price compared to their original cost, stops the cash drain and maybe provides a little capital. It's a strategic move to clean up the fleet.
Any other sales in the works?
They also have a definitive agreement to sell the cold-stacked jackup Noble Highlander for $65 million, expected to close in Q3. And 2 more floaters, the Noble Globetrotter II and Noble Reacher, are currently held for sale.
So a clear, ongoing effort to optimize the asset base, similar to Valaris, but perhaps focused more on clearing out those completely idle, cold-stacked units.
That seems to be a key focus for Noble. Right now, streamline the fleet, reduce the cost burden of inactive rigs, and ensure capital is focused on the active earning fleet and potentially newer assets coming from the Diamond acquisition.
Okay, that gives us a really good feel for their operational philosophies and how they manage their fleets. Noble may be a bit broader, Valaris hyper-focused on the high end, but both actively trimming the edges. Now, let's talk money. Section 3, the financial pulse. Revenues, earnings, cash flow. How did Valaris perform in Q2 2025?
Valaris reported total operating revenues of $615 million in Q2. As we noted, there was a slight dip from $621 million in Q1.
Okay, revenue slightly down. But what about profitability, EBITDA?
That was the positive surprise. Their adjusted EBITDA surged to $201 million. That's up significantly from $181 million in Q1.
$201 million. And how did that compare to what they had guided the market to expect?
It significantly exceeded their own guidance. Their forecast range was $140 million to $160 million. So coming in over $200 million was a substantial beat. That usually gets Wall Street's attention.
Definitely. A $40–60 million beat on EBITDA is pretty significant. What drove that? Was it just that high revenue efficiency kicking in, or was there something else boosting the numbers?
It was a combination. Strong operational performance was certainly part of it, reflecting that high efficiency and good cost control. But a major contributor, about half the beat actually, was a $24 million one-time benefit.
Ah, a one-off item.
Yeah, it came from a favorable arbitration outcome related to some previously disclosed patent license litigation.
Okay, so they won a legal dispute.
Seems so. The benefit showed up in 2 places. About $17 million was a reversal of a previously booked expense, accrual under contract drilling expense, and another $7 million was recovery of legal costs, hitting their general and administrative expense line.
So important to note that about half the outperformance wasn't from core operations, but still, the other half was.
Exactly. Underlying operational strength plus a favorable one-time event made for a strong quarter on the bottom line.
And cash flow. In this capital-hungry business, cash is king. How do they do there?
They generated $120 million in cash flow from operating activities during the quarter. And after accounting for capital expenditures, their adjusted free cash flow was $63 million.
Free cash flow of $63 million. That's cash available after running the business and investing in assets, which they can use for debt reduction, share buybacks, or just building up the bank account.
Precisely. And speaking of the bank account, their cash and cash equivalents stood at $516 million at the end of Q2. Combined with their available credit lines, that gave them nearly $900 million in total liquidity.
$900 million in liquidity. That's a pretty solid cushion, gives them flexibility.
Definitely provides significant financial flexibility to manage operations, invest, and weather any market bumps.
What about their capital expenditures, their CapEx? We talked about that huge long-term need in their 50-year model. What was the spending in Q2?
CapEx actually decreased in Q2. It came in at $67 million, down from $100 million in Q1.
A decrease. Does that mean they're cutting back on investment?
They said it was primarily due to timing shifts in project spend, not a fundamental change in their investment plans. Sometimes payments or big projects just fall into different quarters.
Okay, so timing rather than strategy. And looking ahead for the full year 2025, did this strong Q2 performance lead them to update their guidance?
Yes, they raised their full year 2025 adjusted EBITDA guidance. The new range is $565 million to $605 million. That's an increase of $55 million at the midpoint compared to their previous forecast.
A solid raise, reflecting the Q2 beat and maybe continued operational strength. What about revenue guidance?
Full-year revenue forecast is now $2.25 billion to $2.3 billion, and they noted it's fully contracted at the midpoint, which provides good visibility.
And CapEx for the full year, still the same despite the Q2 dip.
Full-year CapEx guidance remains unchanged, $375 million to $415 million. Interestingly, they mentioned that approximately $70 million of that will be offset by upfront payments from customers who are funding specific upgrades on the rigs they've contracted.
Ah, like that MPD system upgrade we talked about earlier in the DS-15.
Exactly like that. It's a positive sign when customers are willing to co-invest in technology upgrades on the rigs, shows the value they place on those capabilities.
Okay, so Valaris. Q2 revenue, slightly soft, but strong EBITDA, partly one-off. Good cash flow, solid liquidity, and raised full-year profit guidance. Now, let's shift to Noble's Q2 financials. How did they fare, keeping in mind they're the larger company here?
Noble reported total revenue of $849 million in Q2. Similar to Valaris, that was also a decrease from Q1, where they had $874 million.
Okay, so both saw a slight sequential dip in revenue. What about Noble's adjusted EBITDA?
Their adjusted EBITDA for Q2 was $282 million. This was also down from the prior quarter where they reported $338 million.
So unlike Valaris, Noble's EBITDA followed the revenue trend downwards in Q2. Still, $282 million is a substantial number, significantly higher than Valaris's $201 million in absolute terms.
Absolutely. It reflects their larger scale of operations. Even with the sequential dip, they're generating significantly more operating profit than Valaris at this point.
And their cash flow and liquidity situation, how does Noble stack up there?
Noble generated $216 million in net cash from operating activities in Q2 again, substantially higher than Valaris. Their free cash flow was $107 million for the quarter.
$107 million in free cash flow. That's quite strong.
It is. In terms of their balance sheet, they reported total debt principal value of $2 billion, and they held $338 million in cash at the end of the quarter.
So $2 billion in debt, $338 million in cash. That gives a net debt position of about $1.64 billion.
Correct. Around $1.6 billion in net debt. Their total liquidity, including cash and available credit facilities, stood at $870 million.
$870 million in liquidity for Noble compared to nearly $900 million for Valaris. So similar levels of overall financial flexibility there.
Pretty comparable liquidity buffers, yes.
Now, Noble has been quite vocal about returning capital to shareholders. We saw Valaris building cash. What did Noble do in Q2 in terms of dividends or buybacks?
They continued their shareholder return program. They declared a $1.50 per share cash dividend for Q3 2025.
50 cents a share, that's a significant yield for shareholders.
It is. And they emphasize that this brings their total capital return to shareholders through both dividends and share buybacks to over $1.1 billion since the fourth quarter of 2022.
Wow, over $1 billion returned in less than 3 years. That's a very clear capital allocation philosophy. Generate cash, give a good chunk back to the owners.
It's a very explicit part of their strategy and investor proposition. It signals confidence in their ongoing cash generation ability and a commitment to shareholder returns.
How did Noble update their full year 2025 guidance after Q2? Did the sequential dip lead to reductions?
It was a bit of a mixed bag, actually. They slightly reduced their full-year total revenue guidance, trimming it to a range of $3,200 million to $3,300 million.
Okay, revenue guidance trimmed slightly. What about EBITDA?
Interestingly, they increased their full-year adjusted EBITDA guidance. The new range is $1,075 million to $11,150 million.
Wait, revenue guidance down slightly, but EBITDA guidance up. How does that work?
It strongly suggests that their cost management, operational efficiencies, and perhaps the synergies from the Diamond integration are really kicking in and boosting margins more than they initially expected. They anticipate being more profitable even on slightly lower revenues.
That's a very positive sign about their operational control and integration success. What about their CapEx guidance?
The CapEx guidance for the full year was also increased. The new range, net of reimbursements, is $400 million to $450 million.
CapEx guidance up. Why the increase there?
It said it was primarily due to capital associated with recent long-term contract awards. So they're investing in specific rig upgrades or preparations needed to fulfill those new contracts they've won. It's success-based capital spending.
Okay, so Noble. Q2 revenue and EBITDA dipped sequentially, but still large numbers, strong cash flow, substantial shareholder returns, and for the full year, they expect slightly lower revenue but higher profits, alongside increased investment tied to new contracts.
That's a good summary. Resilient performance and confidence in improving margins.
So let's compare their financial health head-to-head now. What are the key takeaways when you put Valaris and Noble side by side financially?
Well, first, scale matters. Noble clearly operates at a higher revenue scale currently. Their Q2 revenue was significantly higher, and their full-year 2025 revenue guidance is about $1 billion higher than Valaris's.
And that translates to profits and cash flow, too.
Yes. Similarly, Noble's adjusted EBITDA and free cash flow figures for Q2 were substantially higher than Valaris's in absolute dollar terms. They're simply a bigger engine right now, generating more earnings and cash from their larger fleet.
What about the backlog, that future revenue visibility we talked about? Who has the edge there?
Noble holds a significantly larger total contract backlog. It stands at $6.9 billion.
$6.9 billion compared to Valaris's.
Compared to Valaris's $4.7 billion. So Noble has over $2 billion more in secured future revenue locked in right now. That provides more stability and predictability for them.
A significant difference in backlog size. And the capital return philosophy. We touched on it, but just to contrast them directly.
Yeah, it's a clear difference in approach, or at least in timing and emphasis. Noble has a very explicit, consistent, and proven track record right now of returning significant capital via dividends and buybacks. That $1.1 billion figure speaks for itself.
And Valaris?
Valaris has stated they are committed to capital returns, but their language is more cautious. They said their strategy may not be linear, and they're emphasizing strong business execution and perhaps further debt reduction as the necessary foundation before large-scale returns happen consistently.
So Noble feels comfortable distributing cash now, maybe due to that larger scale and backlog, while Valaris is perhaps still in a phase of strengthening the balance sheet and proving out consistent execution before committing to large, regular returns.
That seems like a fair interpretation based on their recent performance and commentary. Noble appears to be in a more mature phase of the capital return cycle, while Valaris is signaling it's a priority, but maybe not an immediate linear one.
Okay, that financial comparison is really illuminating. Now, let's move to Section 4, the landscape of contracts. Backlog size is one thing, but winning new work is crucial. Valaris has had a really strong run recently, adding over $1 billion in backlog since April.
They have been very active and successful on the contracting front lately, yes. Adding over $1.0 billion in new contract backlog in just a few months is a significant achievement. That pushes their total backlog up to that $4.7 billion mark we mentioned.
And where did that new $1 billion come from, mostly? Floaters or jackups?
The majority was from floaters, particularly their high-spec drill ships. About $860 million of the new backlog was for floaters, and about $145 million came from jackups. It clearly aligns with their strategic focus on securing work for those premium deepwater assets.
What were some of the key drillship wins driving that huge $860 million number? I recall some news about Oxy in the U.S. Gulf.
Yes, those were major wins. Two of their seventh-generation drill ships, the Valaris DS-16 and Valaris DS-18, secured multi-year contracts with Oxy in the U.S. Gulf of Mexico.
Multi-year deals. That's exactly what they want for these rigs.
Absolutely. Together, these two contracts added 5 years of firm term and roughly $760 million to the backlog. The DS-16 contract extends its existing work with Oxy into late 2028. And the DS-18 gets a new contract expected to keep it busy from late 2026 all the way to early 2029.
Wow, locking up 2 premium rigs for years with a major operator. That's huge validation.
Huge validation, provides excellent revenue visibility, and secures work in a key basin. These are exactly the kind of foundational bookend contracts their strategy targets.
Any other significant drillship contracts that maybe highlight the rates they can get or the technology premium?
Yes, the Valaris DS-15 was awarded a 250-day contract offshore West Africa. It also has options that could extend it for nearly a year.
And this was the one with the customer-funded upgrade.
That's the one. The contract includes an upgrade to an enhanced managed pressure drilling, or MPD, system. And the key is that the customer is funding this upgrade upfront.
What does MPD allow them to do again?
Managed pressure drilling allows for much more precise control of the pressure downhole while drilling. It's critical technology for accessing reservoirs that might be difficult or unsafe to drill with conventional methods, maybe due to narrow pressure windows between pore pressure and fracture gradient. It enhances safety, improves efficiency, and can unlock challenging reserves.
So the fact the client is paying for the upgrade shows how valuable that tech is. And what did that do to the effective day rate?
It resulted in an effective day rate of $540,000 over the firm term of the contract. That's a very strong rate and reflects both the rig's base capability and the value of the added MPD system.
540K's day. That's definitely supporting the premium for 7th Gen plus advanced tech. Any other recent drillship fixtures?
They also mentioned the Valaris DS-10 secured a contract last quarter at day rates in the high $400,000. So consistently strong pricing for these assets.
Okay, so with these new wins, DS-16, DS-18, DS-15, DS-10, how does their near-term availability look for the 7th Gen fleet now?
They've made excellent progress. These awards mean Valaris has now contracted 3 of its 4 7th-generation drill ships that had near-term availability. Those are the DS-10, DS-15, DS-16, and DS-18.
So 3 out of 4 locked up.
Yes. And the average day rates across those new contracts are north of $400,000 per day, confirming that premium pricing. The commercial focus for them now shifts squarely onto securing work for the remaining available one, the Valaris DS-12.
Great strategic progress there. And on the jacked-up side, where did the $145 million in new backlog come from?
Key jackup wins included a significant 4-year extension for the Valaris 110 offshore Qatar. That provides great long-term visibility for that unit. They also secured new work in the North Sea for the Valaris Norway and the Valaris 122.
So solid work across the board, locking up premium floaters at strong rates and securing long-term jackup work too. Now let's turn to Noble. They added about $380 million in new contracts since April. How does that contribute to their massive $6.9 billion total backlog?
Yeah, $380 million is less than Valaris' recent haul, but Noble was already starting from a much larger backlog base. So adding nearly $400 million still represents continued commercial success in keeping their diverse fleet busy and contributing to that huge $6.9 billion total.
Can you give us some specifics on Noble's recent wins? What kind of rigs and regions are involved?
Sure. The Noble Stanley Lafosse, which is a deepwater floater, got a 5-well extension with its current customer in the U.S. Gulf. That extends its work out to approximately August 2027, so follow-on work in a core area.
Okay, U.S. Gulf covered. What else?
The Noble Viking, another floater, was awarded a contract by Total Energies for 1 well in Papua New Guinea that starts in Q4 2025, valued at $34.2 million for the firm 47-day period. Shows their geographic reach.
Papua New Guinea. Interesting. Any others?
The Noble Globetrotter I, known for its specialized capabilities, got a 2-well, 4-month contract with OMV in Bulgaria, starting Q4 2025, valued at $82 million. Again, demonstrating niche capabilities of different regions.
Bulgaria. Okay. Diverse geography. Did they win anything in that emerging carbon capture and storage CCS space?
Yes, this was quite significant. 2 of their jackups, the Noble Innovator and the Noble Intrepid, secured contracts with BP for the Northern Endurance Partnership CCS project in the UK North Sea.
Ah, CCS. Drilling wells not for oil and gas, but to inject captured CO2 underground.
Exactly. The Innovator's contract is for 6 wells, minimum 387 days, starting Q3 2026. The Intrepid's is for 2 wells, 160 days, starting Q2 2026. Both are at a day rate of $150,000.
150K a day for jackups on a CCS project. That's a solid rate and shows diversification into the energy transition space.
It's definitely a positive sign, securing work in a new and growing market segment. They also mentioned the Noble Resilient, another jackup, got a 92-day accommodation services contract in the UK, so using the rig basically as a hotel shows versatility.
Okay, so Noble's wins are maybe smaller individually than Valaris' recent huge floater deals, but they're spread across different rig types, geographies, and even new markets like CCS. It reflects their broader fleet strategy.
I think that's a fair assessment. Consistent wins across a diverse portfolio.
And how does Noble's $6.9 billion backlog break down over time? You mentioned they have great visibility.
They provided a detailed breakdown. For the remainder of 2025, they have $1.1 billion locked in. For 2026, it's $2.3 billion. For 2027, $1.6 billion. For 2028, $1.0 billion. And then $0.9 billion for the period 2029 to 2031.
Wow, $2.3 billion already secured for 2026. That provides a tremendous foundation for planning.
It really does. That multi-year visibility is a significant competitive advantage in terms of financial planning, capital allocation, and managing shareholder expectations.
What does this translate to in terms of contract coverage? Like, what percentage of their available rig days are already committed?
They provided figures as of August 5th for their marketed fleet of 35 rigs, excluding 3 planned for retirement. For their floaters, 62% of available days were committed for the rest of 2025. That drops to 20% committed for 2026 and 5% for 2027.
Okay, so still quite a bit of floater availability to sell for 2026 and beyond. What about jackups?
For jackups, 49% of available days were committed for the rest of 2025, dropping to 36% for 2026.
So higher forward coverage on jackups than floaters for 2026. That makes sense given jackup contracts are sometimes shorter term, but markets might be tighter currently. It highlights that while the backlog is huge, they still have significant capacity to market, especially for floaters beyond the next year or so.
Exactly. It's typical in this industry. Operators often plan major deepwater projects years in advance, but the final rig contracts might only get signed 12-18 months out. So having 20% floater coverage for 2026 at this point is actually quite decent, with plenty of potential upside.
Okay, let's talk day rates outlook. We saw both signing top-tier rigs in the low to mid $400K range recently. How do they see pricing evolving, especially with rigs coming off contract and needing new work?
Valaris provided some interesting commentary here. They acknowledge that while overall market utilization is tightening, which should support rates, there can be periods where specific rig availability increases temporarily, putting pressure on pricing.
So maybe some near-term headwinds.
They specifically expect some pressure on floater day rates through late 2025 and into the first half of 2026. This is likely as a batch of rigs might finish current contracts around the same time, leading to a temporary dip in utilization before new, longer-term projects kick off.
But they're still optimistic long-term, especially for their 7th-gen rigs.
Very much so. They're confident that their high-spec 7th-gen fleet, already largely contracted north of 400 daily, will lead the recovery. Their forecast is to exit 2026 with 90% utilization for these premium assets, and they believe that level of tightness for the best rigs should then drive commensurate day rate increases, supply and demand working its magic for the top tier.
So whether a potential soft patch in early 26, but expect strength to build after that, led by the best rigs, how does Noble's view compare? Did they give a specific rate forecast?
Noble didn't give as explicit a forward-looking rate commentary in the material we reviewed, but their reported leading-edge rates for Tier 1 drill ships, low to mid $400,000, perfectly align with Valaris' recent fixtures.
So they're seeing the same current market reality for top-tier assets.
Yes. It suggests both companies are operating in and reporting on the same fundamental market conditions for these premium rigs right now. Where they differ more is perhaps in that long-term philosophical view, and maybe the breadth of their fleet exposure below the absolute top tier.
Okay, that makes sense. Let's broaden the lens again. Section 5. The broader market horizon. Demand, regions, future opportunities. Despite the different company strategies and outlooks, it sounds like there's a shared optimism about the offshore sector in general, a sense of revival.
Yes, definitely. That's a strong common thread. Both Valaris and Noble express strong conviction in the long-term fundamentals driving offshore activity. They consistently talk about offshore production playing a vital role in meeting global energy needs.
And what are the key reasons they cite for this optimism? Why offshore?
They highlight several factors. One is just the sheer scale of the resource potential in deepwater basins around the world. Another is the compelling project economics, especially for large discoveries. And increasingly important, they often point to the comparatively lower carbon emissions intensity per barrel, produced from many modern offshore developments compared to some other sources of fossil fuels.
Lower carbon intensity, that's becoming a bigger factor for oil companies under ESG pressure.
Absolutely. If you have to produce oil and gas, producing it with the lowest possible emissions footprint is increasingly a strategic objective. Large, efficient offshore projects often screen well on that metric.
And are they seeing a shift in customer investment priorities?
Yes, a significant trend they both noted is customers prioritizing these long-cycle offshore developments over shorter cycle activities, like, say, U.S. land shale drilling, which has dominated investment for the past decade.
Why the shift back to long cycle offshore?
Offshore projects, while requiring huge upfront investment and longer lead times, can offer much larger reserve additions and very long production plateaus, decades, potentially. This provides energy companies with more stable, long-term production profiles and cash flows compared to the faster decline rates typical of shale wells. It seems there's a renewed appreciation for that long-term value proposition.
So looking ahead, they expect more big offshore projects to get the green light.
Both anticipate meaningful growth in deepwater project sanctioning. That's the final investment decision in 2026 and 2027. This includes both greenfield development, starting brand new fields, and new exploration campaigns to find the next generation of discoveries.
But does the math work? Are these projects actually profitable enough to justify the investment, especially if oil prices fluctuate? We talked about Valaris' concern about day rates covering costs.
That's the crucial question. But the data seems supportive, at least from the operator's perspective. A key indicator cited is from Rystad Energy, an industry analysis firm. They found that over 75% of the deepwater spending expected to be sanctioned globally in the next 3 years is tied to projects with break-even oil prices below $50 per barrel.
Below $50 break-even. And where are oil prices now, notionally?
The current 5-year forward oil price curve is sitting over $65 per barrel. So if you can develop a project that makes money, even if oil drops to $50 and the market expects prices to stay well above $65, that's a very strong economic incentive.
Yeah, that's a healthy margin for error and potential profit. It explains why operators would be confident sanctioning those projects.
Exactly. It underpins the expectation that the current pipeline of potential projects will convert into some contracts for rigs and services. The economics are compelling at expected future prices.
Okay, so the overall picture looks positive. Where are the specific geographic hotspots? Where is Valaris seeing the most future demand, particularly for its floater fleet?
For Valaris, offshore Africa stands out significantly. They identify it as the most active region for future floater demand, projecting it will account for roughly half of their long-term opportunities. That's a huge focus.
Half their opportunities in Africa. Which countries specifically?
They mentioned expected growth offshore Nigeria, where 2 multi-year programs are expected to come to tender soon. Ivory Coast is another, potentially needing 2 rigs starting in 2027.
And Namibia. That's been in the news with big discoveries.
Yes, Namibia is a key one. Total Energy's huge Venus discovery, and potentially others nearby, could lead to several years of multi-rig development work. It could be a major new deep water province. Ghana also has potential, with a new discovery at the Ebenekoma field, possibly generating more demand.
So a lot happening across West and Southern Africa. Is Valaris already active there?
Yes, they have a presence. They mentioned the Valaris DS-9 is returning to Angola soon for work with ExxonMobil, and BP has a tender out in the Mediterranean, specifically Egypt, that could be work for the Valaris DS-12. So they're well positioned to compete for this expected African growth.
Okay, Africa is key for Valaris. What about Brazil? Still a major deepwater market.
Definitely. Brazil is characterized as the largest single market for benign environment floaters. The conditions there are generally less harsh than places like the North Sea or even parts of West Africa.
And what's the demand picture in Brazil? Mostly Petrobras, the national company.
Petrobras's rig count is expected to remain pretty stable. They have ongoing tenders and needs for existing capacity in their giant pre-salt fields like Búzios, Mero, and Tupi. This offers potential follow-on work for rigs already there, like Valaris' DS-8.
But is it just Petrobras, or are other companies active too?
That's the encouraging part. There's increasing demand from international oil companies, IOCs as well. Equinor is reportedly looking to add a 3rd rig offshore Brazil. Shell has issued a tender for its Gato do Mato project. This diversification beyond just Petrobras is a very healthy sign for the long-term market in Brazil.
Good to see IOC stepping up there. What about the U.S. Gulf of Mexico? Always a core deep water region.
Valaris sees customer demand remaining healthy in the U.S. Gulf. They expect the market there to stay relatively balanced with the existing rig supply. So, steady demand, but maybe not the explosive growth projected for Africa or the scale of Brazil.
And any other regions Valaris highlighted? Maybe outside that golden triangle of U.S. Gulf, Brazil, West Africa.
Yes, they noted requirements emerging for 7 drill ships across India, Southeast Asia, and Australia. Combined, that represents over 10 years of expected firm contract term.
7 drill ships needed in Asia Pacific. That's quite a lot.
It is, and interestingly, they pointed out that this demand could potentially draw drill ship supply away from the Golden Triangle, where currently only 5 drill ships are working or warm stacked outside of the main 3 basins. So demand in Asia could actually help tighten the market further in the Atlantic Basin.
That's an interesting dynamic. Demand in one region pulling supply from another. Now, thinking about Valaris's bookending the white space strategy, are they seeing those shorter-term gap fill opportunities materialize to fit between the big contracts?
Yes, they mentioned a positive recent development here. There's been increased customer interest in shorter-term programs, specifically for the first half of 2026, particularly in the Golden Triangle.
Perfect timing to fill potential gaps before the bigger 2026, 2027 projects kick off.
Exactly. It aligns perfectly with their strategy. Secure the long-term anchor contracts first, then plug those shorter gaps with high-value, efficiently executed work. It shows the market is providing those tactical opportunities.
Okay, that covers the floater market outlook well. What about jackups? We heard utilization is very high globally.
Yes, the global marketed utilization for jackups ended Q2 at 90%. That marks 3 consecutive years at or above that level, a clear sign of a very strong, tightly supplied market globally for jackups.
And how is Valaris positioned in this strong jackup market? Where are their rigs concentrated?
Their jackup fleet is strategically concentrated in what they see as the strongest markets. One is ARO Drilling in Saudi Arabia, their joint venture with Aramco, which provides very long-term contracts and stability.
Right, the Aero JV gives them a protected baseload. Where else?
The North Sea is another key area, where Valaris holds a market-leading position, operating some of the most capable harsh environment jackups. They also have a presence in niche markets like Trinidad and Australia, where specific rig capabilities are needed.
So, focused on premium segments even within the jackup space, do they have much availability coming up?
For their benign environment jackups, those for calmer waters, they have open availability in 2026 for only 2 rigs.
Only 2 out of your whole jackup fleet.
Only 2 benign environment ones, yes. The Valaris 106, which is currently in Indonesia and benefits from Indonesian flagging rules that can favor locally flagged rigs, and the Valaris 107 in Australia, which they expect to be the only jackup with 2026 availability capable of meeting multiple opportunities down there.
Wow, very limited availability. That underscores the tightness of the market they're operating in. What about the North Sea? More competitive there?
They do anticipate increased competition towards the end of this year in the North Sea, as more units might become available. However, Valaris has solid contract coverage already locked in. They highlighted the Dutch sector specifically as a bright spot.
The Netherlands, what's happening there?
They expect 3 programs, each lasting at least 1 year, to start by early next year in the Dutch North Sea. These focus on gas drilling, which is important for European energy security, but also plug and abandonment work, decommissioning old wells, and even new energy projects. It shows the diversity of work available for jackups in mature basins.
Good to see that diversification. Now, are there any challenging spots or broader industry trends impacting them? What about semi-submersibles?
Yes, the market for semi-submersibles, particularly older or midwater units, remains challenged. Valaris specifically mentioned they expect idle time for their MS-1 and DPS-1 semis, especially offshore Australia. They're continuing to monitor the market for their 2 remaining semis. Seems clear that demand has shifted heavily towards high-spec drill ships for deep water and capable jackups for shallower depths, leaving less room for traditional semis in many regions.
So that part of the market is tougher. What about Saudi Arabia? Aramco had previously ramped up rig counts significantly. Has that changed?
Valaris confirmed, through their ARO Drilling JV, that the Saudi rig count is now back in the mid-50s. That's roughly back to the levels seen before the major ramp-up in 2022 and 2023.
So the big expansion phase is over. Does that hurt Valaris's ARO JV?
Not necessarily. They emphasize that Valaris's ARO rigs are mostly contracted through the end of the decade on long-term deals. So while the overall market might have plateaued or slightly decreased, ARO's position seems very secure, providing that stable baseload for Valaris regardless of short-term market fluctuations in Saudi.
That long-term visibility from ARO is clearly a major asset. Lastly, overall customer confidence. Despite all the macro volatility, oil price swings, geopolitical risks, are clients still committing to these huge multi-year offshore projects?
According to Valaris's CEO, yes. He noted that customers generally feel confident about contracting rigs and moving forward with developments.
What's driving that confidence in this environment?
Two main things, really. First, a strong underlying belief in the long-term need for the oil and gas resources these projects will produce. And second, as we discussed, the compelling economics of many of these projects, especially with break-evens below $50 per barrel compared to current forward prices. Clients seem focused on the long-term supply need and the project viability, making them willing to commit capital despite near-term uncertainties.
It suggests a focus on fundamentals over short-term noise.
Exactly, a pragmatic view driven by resource need and project economics.
Okay, this brings us perfectly to Section 6, the ultimate question, long-term sustainability and the industry outlook. And this is where Valaris' unique 50-year analysis delivers that really stark warning we hinted at earlier. Let's unpack the conclusion of that model. What does it say about Valaris' long-term viability and maybe the industry's?
It's pretty sobering, frankly. When they run all the numbers, replacing rigs twice, upgrading them once, covering decades of operational costs, the total estimated cost to run Valaris' business, just the core drilling part, for half a century comes out to a staggering $195 billion.
$195 billion just to keep the current fleet running for 50 years.
Exactly. So to simply break even, just to sustain operations without making any profit or paying back original investors, the company would need to generate approximately $200 billion in revenue over that same 50-year period. It puts the sheer scale of capital cycling in this industry into perspective.
It's a mind-boggling number, but how does that compare to the revenue they actually generate? That's the critical comparison, right?
Yeah.
Where does the money-burning claim come from?
That's where the model delivers the punch. The analysis reveals a potential dire shortfall based on current or recent revenue levels. If you take Valaris' 2023 revenue, which was about $1.784 billion, and just project that forward for 50 years,
Okay, simple projection.
you only get $89 billion in total revenue.
$89 billion generated versus $200 billion needed just to break even.
Precisely. Not even half of what the model says is needed for long-term sustainability. Even if you use a more recent figure, like their trailing 12-month 2024 revenue of $1.13 billion, which seems low, may be affected by rig reactivations, the 50-year projection is only $113 billion. Still, not enough.
So the model basically says, at recent revenue rates, the business doesn't generate nearly enough cash over the long haul to cover the fundamental costs of replacing its own assets.
That's the stark conclusion. It suggests that for Valaris, based on this model, to be a truly sustainable business over a 50-year horizon, their current annual revenue would need to roughly double.
Double the revenue, just to break even long term.
According to this specific analysis, yes. Without that, the model implies an unsustainable path, potentially leading to recurring financial distress or bankruptcies every, say, 10 to 30 years, coinciding with cycles of major reinvestment needs. It's a deeply challenging picture of the industry's underlying economics if this model holds true.
And what's the single biggest factor that could change this? What's the critical lever?
Day rates. The entire conclusion of this 50-year analysis, as the source material puts it, really hinges on day rates. They are the absolute key.
Okay, so what kind of day rates does the model say are needed?
Just looking at the drillship fleet alone, the analysis suggests a minimum average day rate of $561,000 per day would be needed over the entire 50-year period, assuming 100% utilization just for the drillships to cover their own full lifecycle costs, including replacement.
$561,000 a day, average, for 50 years at 100% utilization. That's described as incredibly high.
Incredibly high, especially when you think about the historical cyclicality of day rates, which have often been far below that level for extended periods. Achieving that average consistently for half a century seems like a monumental challenge based on past performance.
And the point here isn't just Valaris' internal calculation, right? It feels like a message to the broader industry.
I think that's exactly right.
Yeah.
It's almost Valaris saying, look, based on our analysis of the true long-term costs, the prices the industry is typically charged are fundamentally too low for sustainable returns over the full asset lifecycle. It forces the question, are oil companies actually paying the full cost required to ensure a healthy, sustainable drilling sector exists long-term?
A provocative question. How do current rates compare to what this model says is needed? You mentioned $400K to $700K recently, but also potentially high OPEX.
Right. So while leading edge rates for the best rigs are currently strong, sometimes hitting $500K or more, the average rate across the whole cycle needed is that $561K in a minimum, according to the model. And if operational costs, OPEX, are sometimes as high as $400 down $450K per day, as mentioned in that caveat.
Then even a $500 K day rate doesn't leave much or anything to cover the capital costs, overhead, debt service, and eventual replacement.
Exactly. In that scenario, the model views the current proposition, even at seemingly high day rates, as potentially very, very losing when you factor in the full 50-year picture. For true long-term sustainability, according to this analysis, average day rates would need to be consistently around $650,000 or maybe even much higher.
650K plus
Yeah,
consistently. That paints a, well, very pessimistic picture for long-term buy and hold investment in offshore drilling, doesn't it?
it does. Based solely on this long-term cost model. It suggests that, at historical and even current average rates, it's been a money-burning business over the very long run. This aligns with a candid admission from Valaris' CEO mentioned in the source owning the stock as a trade on the cycle, rather than a multi-decade investment based on current fundamentals.
Remarkable candor, really. So, if this model is even directionally correct, what needs to happen for the industry to become truly sustainable long term? How could rates get pushed up to those levels?
The analysis suggests market forces would need to drive a fundamental shift. Rates really, really need to go up and stay up. How could that happen? Several ways, none particularly pleasant for some players.
Like what?
Industry consolidation is one path. Fewer, larger players could lead to more pricing discipline, less irrational bidding during downturns.
Fewer competitors means more pricing power.
Right. Another path is simply more companies going out of business, permanently removing capacity and competition from the market. Bankruptcies that lead to fleet reduction, not just financial restructuring.
Or rigs being removed.
Exactly. Rigs being permanently taken out of service, scrapped, destroyed, converted, without being replaced by new builds. The overall supply of capable rigs would need to shrink relative to demand, forcing prices up to levels that reflect the true replacement cost economics. It's a stark vision of market rebalancing.
A potentially painful rebalancing to reach sustainable levels. Now, contrast that dire long-term view with Noble. They seem much more confident, right? Focused on recovery and shareholder returns.
Yes, it's a completely different tone and focus. While Noble's leadership acknowledges some near-term softness or volatility, they emphasize the positives. They point to tangible, encouraging indicators of increasing demand levels by late 2026 and into 2027, especially in key growth regions like South America and Africa.
So they see the cycle turning favorably, driven by demand fundamentals.
That's their narrative. They see a cyclical recovery underway, driven by the need for energy and the attractive economics of deepwater projects for their customers. They're not publicly framing it as an existential crisis for the industry's business model in the same way the Valaris analysis does.
So Noble's strategy is more about navigating the cycles effectively.
It appears so. Their focus is on adaptation, managing costs prudently, rationalizing the fleet by selling non-earning assets, successfully integrating Diamond offshore, and strategically positioning themselves to capitalize on that growing deepwater demand they foresee.
They seem confident they can generate good returns within the existing market structure, provided they execute well.
That's the message conveyed by their actions, increasing EBITDA guidance despite slightly lower revenue forecasts, significantly increasing capital returns to shareholders. These moves signal confidence in their ability to manage the business effectively and profitably in the near to medium term, even within the current industry pricing environment.
So we really have these two distinct, almost opposing narratives playing out. Valaris, using this unique long-term lens, flags fundamental sustainability issues at current average rates, suggesting a need for structural change and much higher prices. Noble, focusing more on near-term execution and cyclical recovery, projects confidence and returns capital.
It leaves us, and you, the listener, with a really critical question about the industry as a whole, doesn't it?
Which is?
Is offshore drilling an inherently sustainable long-term investment proposition? Can it consistently generate the returns needed to cover its massive full lifecycle costs over decades? Or is its deeply cyclical nature, as highlighted perhaps by the Valaris analysis, mean it's destined to be more of a series of strategic trades investments timed to capture the upswings, highly dependent on volatile day rates and market conditions, rather than a stable, long-term value generator?
That really is the multi-billion-dollar question for investors and the industry itself. How that question gets answered will shape the future flow of capital into this vital energy sector.
Absolutely. Will the industry consolidate and rationalize enough to achieve structurally higher pricing, or will the cycles just continue?
Okay, let's try to wrap this up. We've peeled back a lot of layers on Valaris and Noble, these two titans of offshore drilling.
We really have. And the contrasts are stark.
We've seen Valaris, particularly through that, let's call it provocative, 50-year sustainability analysis paint a picture where the current economics are fundamentally challenging. It strongly suggests day rates need to climb significantly, maybe double, for true long-term viability to avoid being a money-burning business over the full cycle.
A very sobering long-term perspective focused on full replacement cost economics.
Meanwhile, Noble, while acknowledging some near-term market softness, project a much more confident path forward. They're buoyed by their integration success with Diamond, their strong current financial position, consistent shareholder returns, and what they see as an encouraging outlook for deepwater demand picking up steam in the coming years.
A more pragmatic, cycle-focused approach, emphasizing execution and capturing the anticipated upswing.
But what really stands out, the common denominator here, is that for both companies, whether you're looking 5 years out or 50 years out, day rates are the absolute key, the ultimate barometer of success and sustainability.
Everything hinges on the price they get for putting their rigs to work. This deep dive really illuminates just how intensely the future of these multi-billion-dollar companies and the health of the entire sector depends on the day rate achieved for these incredibly expensive, highly specialized assets. Does that rate truly reflect the full cost of providing that capability over the long haul?
Which leaves us, and you, with that final thought to ponder. Given the undeniable global need for offshore production and the seemingly strong economics of many new projects for the oil companies themselves, how will this play out?
Will the drilling industry evolve? Will we see more consolidation, more rigs permanently retired, finally pushing day rates towards those historically high, potentially sustainable levels that Valaris' analysis hints are necessary?
Or will the market continue its historical pattern of boom and bust? Will investment in the sector remain more of a strategic trade on the cycle rather than a stable, long-term play? The future of deepwater energy production really hangs in the balance.
The next few years will be telling as these demand forecasts meet the reality of rig supply and operator discipline.
So keep a close eye on those day rates. Track the utilization of those high-spec rigs. That's where the real story of this industry's financial health and long-term sustainability will continue to be written.
Couldn't agree more.
Until next time, keep digging deeper into the world around you.